I was talking to a big hedge fund manager. I won't mention the name. That's kind of a public name. And, he was talking about how he never takes out debt because he doesn't need to. And why would he? But they came to him and offered him a 5-year, 1.6% loan. And he took out, X millions of dollars of money because at that rate, why wouldn't he?
Personally, I mean.
Personally, yes.
Yeah.
Why wouldn't he? Right? Pretty obvious at that point. At 1.6%, you can make more than 1.6% a year. And sure, I'll take that loan, right? And guess what? Guess when it's coming due? In about 6 months, right? He's not the only one. It's everybody. It's the whole system, right? Now, the question is, did they get 10-year paper? Did they get 20-year paper? Or was it 30 years? But there's lots of 5-year paper. But if interest rates have gone from 0 or, 1.5% in the case of our wealthy hedge fund investor to now 7.5% for that same loan, or 6.5% or whatever that is, right? That's a 5% difference. And that 5% difference means A, that you may not want that money. You probably don't anymore, right? Because in order to take that loan, again, to reissue that debt, you have to have something that makes more than that. This is the whole idea of the discount rate, but in a very practical supply and demand sense, right? And so in those situations, that money goes away. That liquidity comes just off the table. You have to deleverage. If you own something that was making 5% against that 1.5% loan, guess what? That 5%, you sell that asset. You sell that investment. That is a deleveraging effect, right? Your assets have to equal your liabilities. And at the end of the day, that's what's happening. All of the issuance that's happened at these lower levels, it's not a matter of the interest rates going to 4.5% that mattered as much. That 4.5% for any new loans that are going up matters. But the bigger deal is all the money that was already issued that's coming off the table. That's the bigger liquidity draw.
Yeah.
And so this is the critical part. And by the way, it's not just money that's been borrowed, by the way. That interest rate affected because via the credit spread, right? That affected also, dramatically, a ton of people coming and raising equity during that time, right? So venture capital valuations were incredible in 2021 because interest rates were 0. There was free money floating around. Guess what? Valuations in venture capital have come down about 75%. Why? Because people can see that they're not going to be able to raise more money. There's not enough liquidity out there anymore. But guess what? They're also running out of money. As you roll forward here, people raise money for their companies, not for 20 years. Maybe they should have, but not many people did. They said, well, I got a runway of 5 years. That should be good. No, probably wasn't, right? Especially it's pretty simple supply and demand at the end of the day. The same is true here, but it operates over long periods of time, not over 6 months, a year, not even 2 years, because there's a refinancing process that happens that lasts for some time, and people don't need to refinance. They can use the money that's already in the system to make those investments. But again, at some point, that money comes due, and the next interest rate is not the interest rate you had before, and then the liquidity comes off the table. So that's what we're up against now. We're hitting a 5-year period in about 6 to 9 months. And that's the middle. That doesn't mean it starts. It really starts, if you go look, starting in about Q3 of this year. I'm not the only one talking about this. It's a relatively well-known phenomenon. The question is, how much does it matter? And I'm here to say it matters a lot. There's a lot. But I think this simple idea of right now, I'm not saying that this is the bubble or any of those things. Let's just talk liquidity, right? Just liquidity. Markets determine the outcome of that liquidity more than anything else. But incrementally, right? Who's the incremental buyer or seller? If the market goes nowhere, what's happening to liquidity? And what I'm here to tell you is that liquidity with the market going sideways has been increasing over the last 5 years, last 10 years. Usually is. And for the first time in a long time, we're actually seeing that incremental liquidity coming off the table. Right? And so as we're getting a significant liquidity pull off the market, if it is not met by a counterforce, which is U.S. equities, global equities going higher, assets broadly going higher, in enough of a manner to counteract that, then equity markets could decline. And if they begin to decline, then you have to be careful because it begets its own negative liquidity in the system. And I think this is the important part, right? And this is why prediction, which again, everybody wants to know my prediction, right, is so dependent on markets themselves. And so, again, this is not to scare anybody. And by the way, it's not predictive in the sense that if markets go up, it will counteract this liquidity, right? The biggest effect against that draw on liquidity, call it 20 trillion, is an increase in market valuation. So if the stock market goes up 10%, that's $20 trillion of new collateral. And that'll counteract, becoming liquidity. Now, that'll be an overhang. It'll create some issues, right? And it'll be subtract. But if we don't go up, and again, this is why it's so important for the Federal Reserve and the Treasury and the politicians of the day to goose markets and to get them moving, to try and get that 10-year yield down, right? To get a little bit more liquidity and push bonds up. But they haven't been able to do that. All right. So that's your warning sign.
In this scenario, do we wind up in this kind of like Martha Reeves and the Vandellas, nowhere to run to, nowhere to hide scenario here? Is there any asset class? Do you see commodities? Do you see crypto? Do you see gold as being a potential hedge, or does it just all get swept on the same tide of liquidity?
Yes, I do see. People will move towards what's working, and the amount of liquidity that exists in gold, in Bitcoin and in industrial commodities is minimal, relative to the equity markets, right? So people will need to hide. I mean, you can't hide cash either, right? Because inflation will take that away. So money has to go somewhere. And, in 1968, the percent value of energy in the S&P 500 was 3%. In 1982, it was 33%. Now, in real terms, the equity market declined in real terms, right? 67%. But those energy names compounded nicely due to inflation, right? For 15 years. So they became just a bigger part. What you can't avoid is multiple contraction across assets. So it is an overhang on all assets in that sense. At the end of the day, if you get 20% on a 10-year yield, that's probably an asset you're going to want to own at that point, right? And if you want to own that asset, if money's flowing there, that's got to flow out of everything else.